Please welcome the Chair for the Greater Oklahoma City Chamber, Percy Kirk.
Good morning. This is like about every other one of our chamber meetings that we have a hard time getting people into seats because you all like one another. It's perfect. Well, welcome to the Greater Oklahoma City Chamber's 9th Annual State of the Economy. When we first hosted State of the Economy 9 years ago now, we knew that chamber member businesses were hungry for information and intelligence about the economy, not only to help you anticipate Oklahoma City's growth, but also to help you navigate the future growth of your own companies and businesses. I'd say clearly now, the need for this kind of information is still there. As we approach an election year and the start of a new decade, I hope that today's conversation about local and national trends will act as a compass for the years ahead. But before we get to that, I first want to thank and recognize our signature sponsor for today's event, Arvest Bank. Please join me in thanking our sponsor for today's event. With rates at under 3%, unemployment in Oklahoma City continues to be historically low. Despite flat job growth at the state level, the Oklahoma City metro area has seen positive gains in 2019. Through the first 3 quarters of the year, the average non-farm employment for Oklahoma City is up by nearly 1.3%, or 8,300 jobs over the same period last year. While below our original forecast, Oklahoma City continues to emerge as the center of activity for the economy in the state. You can learn more about Oklahoma City's growth when we release the 2020 economic forecast, and we do that in early February. It'll provide you more insight at that time. Job growth has been buoyed by progress being made by some of our region's most significant employers. A perfect example of this is the completion of the first hangar built specifically for the KC-46A. Tinker Air Force Base is already the largest single-site employer in the state and definitely the anchor of our region's aerospace industry. As the depot for maintenance, repairs, and overhaul on the Air Force's next-generation refueling tanker, the new campus will add thousands of jobs over the metro area and represents the single largest construction project on Tinker Air Force Base since the 1940s. As Senator Jim Inhofe said at the ribbon-cutting ceremony, this project will secure the lifespan of Tinker Air Force Base and, by extension, our region's aerospace industry for another 6 decades. I think we can all be pretty proud of that. But aerospace is not only the only industry with signs of growth in our region. OU Medicine's new patient tower, which is currently under construction, represents the largest hospital expansion in Oklahoma history. When complete in the fall of 2020, it'll add significantly to Oklahoma City's healthcare capacity and mark a significant investment in the Innovation District, which is one of Oklahoma City's areas with the most potential for growth in the next decade. We also can't ignore the new capital projects in downtown Oklahoma City. Decades of public investment through 3 rounds of MAPS program, and don't worry, I'll get to MAPS 4 before we leave today. But we've invested $1.8 billion in the downtown core. And while that's certainly an impressive number, it's the amount of private investment that really tells the story. Since 1995, estimated private investment spending totaled $3.9 billion. In total, the combination of city investment through MAPS, along with other public and private sector investment in the downtown study area, has reached an estimated $7 billion in full in the MAPS era. The investments currently underway from the construction of the Oklahoma City Convention Center, the Omni Hotel, the Oklahoma Contemporary Museum, and renovation of the First National Center will only further strengthen our highly successful visitor and tourism industry and continue to lead to additional investment. So when you're driving around town, I encourage you to look at the dozens of cranes that dot the sky. It's a true sign of economic progress and a symbol of what follows when Oklahoma City invests in itself. Today's panel of experts and our dynamic keynote speaker will do their best to prepare you for the year ahead. And if these conversations prove to be like those in the past, they'll give us plenty to discuss in the coming months. And so the first thing on our today's agenda is a panel discussion with 3 regional economists. As we prepare to start that discussion, keep in mind that we'll have a brief Q&A period at the end of our panel discussion and also after our keynote speaker. So start thinking about your questions now and throughout the lunch if you would. I'd now like to introduce our panel moderator for today. Please help me in welcoming to the stage President and CEO of Jordan Advertising and immediate past chair of the Oklahoma City Chamber, Rhonda Hooper. Rhonda.
How's it going? Are you enjoying that amazing salad? No one touch these salads at table 107 until we get done. My name is Rhonda Hooper, as Percy said, and I'm President and CEO of Jordan Advertising. And I definitely will be moderating today, and I feel like you've seen me quite a few times, so I'll change things up on you. I promise I won't mess y'all up. But I'd like to introduce our panelists. Their bios are in your program, and they're extensive, and they're amazing people. So as I introduce them, please help me welcome Dr. Robert Dauffenbach, Senior Associate Dean for Economic Development and Impact, and Director of the Center for Economic and Management Research at the Price College of Business at University of Oklahoma. All right, we have Dr. Russell Evans, who is Associate Professor for Economics and the Executive Director of the Stephen C. Agee Economic Research and Policy Institute at the Meinders School of Business at Oklahoma City University. And Dr. Mark Snead, President of RegionTrack, an Oklahoma City-based economic research firm specializing in regional economic forecasting and analysis. As Percy said, we will be in the last few minutes of our Q&A, or we'll have some Q&A from the audience. So please be thinking of some questions you might want to pose. I can tell you our panelists are amazing individuals and they won't bite you back, okay? So, well, maybe Mark will, but not, well, Bob, no. Everybody's pointing to you, Bob. What's wrong with that picture?
I don't know. I'm such a quiet
individual, right?
Yeah.
Cool.
Unassuming.
Okay, well, I have 6 questions I'd like to pose. And the first one, Russell, if you take the lead,
Sure.
and then I'd like everybody else to weigh in on that. But in looking at the state and the Oklahoma City metro economies, what are the areas that you're most encouraged about? But on the flip side, where are you most concerned?
Yeah, so I'll start kind of big picture and just be brief. So I'm really curious to hear Bob's and Mark's comments on how they feel things are going. I think for me, I guess the punchline would be that the signs, the areas of concern far outweigh the areas of encouragement for me right now. I think big picture in the U.S. economy, I think I'm encouraged by the fact that maybe things aren't as bad as we thought they could be. I think if you look at some of the most recent data, you look at the weakness that we're seeing in Europe and some of the global economy, that looks like England and Germany might just narrowly avoid being officially classified as in recession. But very weak economic conditions globally. We're kind of in a global manufacturing recession. And so there's some concerns about the extent to which the United States will import that economic weakness. And so I think some of the recent numbers maybe lead you to believe that, that maybe things are going to be better than worst feared. I don't know, is that encouraging enough? How was
Better
that?
than worst?
Better than worst feared. How was that?
Is that our theme line for 2020?
Right.
Okay.
On the flip side, as we kind of look at this at the state's economy, I see areas of concern. I see a few sectors that are performing pretty strong through 2019. But as Percy noted in the opening statement, kind of the cycle that we expected to see in 2019 has come to pass. We talked early, I think even last year at this time, we talked about the metaphor of being in a situation in which economic weakness develops so slowly that we almost don't perceive that we're getting sick as we're getting sick, I think was the kind of the tool we used last year to try to describe it. And I think that's kind of where, I still think that's where we're at. And so I think there's a good chance that the state finds itself in a mild contractionary cycle. I won't use the R word in this audience, but a mild contractionary cycle in the first couple of quarters of 2020. And so my level of concern is actually pretty high. I hope that I'm on an island with my concern. I hope that Bob and Mark have much different perspectives.
Russell, we hope you're on an island as well.
I know.
Okay. All right. Bob?
Well, first I want to say we're always happy to have the questions ahead of time.
That's right.
And I've taken that a step further this year. I've started writing out the questions, not writing out the answers
right
to
there.
the questions.
Okay.
Yeah, and the rationale for that is that I feel that I can better control this old person tendency to tell too much truth. And so I promise not to read the things that I've written out, but I got to say that for the Oklahoma City metro area, we can be very proud of what you've accomplished. We've had just tremendous gains since the great financial crisis, that recession of 2008, 2009. You've gained 75,000 jobs. You've risen 13% in employment in comparison to 10% nationally. In terms of personal income growth since 1990, you're 2.3 times higher in real personal income in the Oklahoma City metro area than you were in 1990. It's 130% real gain, and that's really something to be proud of. In terms of the share of the state's personal income, you've risen from 33% to 38%. And that's astounding. Tulsa has been fairly constant at 29 or 30%, depending on how oil prices are doing. They're more sensitive there than even Oklahoma City is. Now, what's the flip side? The flip side is the balance of the state. Non-Tulsa, non-Oklahoma City metropolitan area has fallen from 40% to 32% in share of personal income. Employment growth has been essentially stagnant, if not declining. When we went through our little mini recession in 2015 and 2016 with declining energy prices, we saw very drastic declines in what I call the balance of the state. Now, a 1% shift in personal income within the state is $1.8 billion. So that gives you an idea of what the magnitudes have been of those declines.
Wow. Mark?
Yeah, so what encourages me and what maybe concerns me, there may be mirror images of each other. What encourages me is that we're actually, I think we're navigating this energy cycle fairly well. If you go back to the past few cycles, we went from a complete industry restructuring in 2009, 2010 to a really extended but fairly shallow 2-year state recession. And at this point, we really have been facing headwinds. I think I would use the description right now, we're in an oil and gas headwind period. Yeah. And it is, I think Russell highlighted something that's quite interesting. It's been almost imperceptible. That's right. Unless you're looking at the data. And in the data, we now really have 12 months of this behind us. We've literally been in this for 4 quarters. So what I would suggest, instead of the last cycle where we shed 20,000 plus wage and salary workers, at this point we've lost a couple of thousand. So I think what concerns me is that we're still wrestling with oil and gas cycles. I'm encouraged by the fact that we're dealing with them better, but concerned the industry is getting larger, far larger, and we're still wrestling with this volatility.
Yeah, I think I'll just finish there. I think in some ways the story of 2020 will be a decoupling story. Kind of to what extent has the state's economy decoupled from the energy industry? How well can we manage it? And to what extent is the Oklahoma City economy decoupled from the state's economy? And so to what extent can the city sort of generate its own economic reality in spite of what's happening in the rest of the state? I think we'll find out a lot in 2020, sort of the extent of this decoupling, if it's happening at all.
Okay. All right. Well, the next question is relative to education and workforce, and there's been a lot of recent discussion relative to automation and the future of work. But can you speak to some of the opportunities in the future, as well as the challenges for Oklahoma companies as we face those in terms of education and workforce? And Bob, why don't you lead us off with this one?
Right. Computerization, robotics has been with us for some time. I was a young assistant professor in Detroit, Michigan, my first job out of graduate school, and personally witnessed robotics taking over the welding of cars and the painting of cars there to mass layoffs associated with that move. Increasingly, we've seen robotics come into play more and more. And it'll be kind of like, well, the myth of you boil a frog slowly, well, they never notice it and jump out. You know, this is a myth, by the way, but it's a nice.
You haven't tested it, have you?
No.
Okay.
It's a nice analogy, but I think what we will see as we move ahead, artificial intelligence, driverless vehicles. You know, if we keep taking sort of 5-year slices at a time, 5 and 10-year slices at a time, we'll see a lot of difference. But it will be rather imperceptible from just 1 year to the next what's going on. But the implications are tremendous. There are 2 million people in this economy that drive trucks, for example. So we could have some very, very outstanding, dramatic shifts in workforce. I would contend that it's going on already, though. We've seen in the last 26 years, going back to 27 years, going back to 1992, and you've heard me say before, there has been no growth in jobs for those who have high school or less educational attainment in those 26 years, and the numbers just keep getting worse. In 2018, we had for the first time more graduates, bachelor's degree graduates, highest attainment level graduate with a bachelor's degree, higher than those who have high school diplomas in the employed workforce in the economy. Now you may say, well, that's just because people have more education, but I say that's really poor economics. Consider this thought experiment. You and I are in competition, producing in the same industry, and you hire college grads and I hire high school grads. You pay your college grads more because you have to pay them more, and I pay the high school grads less, but let's assume they have equal productivity. Well, then my costs are going to be lower than yours, and I'm going to put you out of business. The point being, college grads are paid more because their productivity justifies their wage. And we see that going on, and the wage differentials are just huge. Now, we have some workforce development initiatives in the state. They're doing good work. They've got a lot of good numbers up there. We've got the Office of Oklahoma Workforce Development, and they track such things as, well, let's look out to 2028 and what's the job prospects look like. Well, 2/3 of their titles are colleges required for the 2/3 of the titles that they list there. And so we really have to rethink education in this state. We have to think more in terms of not K through 12, but K through 16, if not even higher. You're starting to hear talk that master's degrees are the new bachelor's degrees. So these are trends. They're solid, they're in place, but it is a K through 16 kind of deal. You want to be an engineer, you want to be a scientist, it starts in grade school. And we need to talk more about and engage and plan and execute in that realm of doing a much better job of getting people through these higher educational levels.
Yeah, so I think, one of the interesting, when you think about like skills gaps and where our jobs going, I think kind of to Bob's point, because it does happen so slowly and somewhat imperceptibly, I think when we talk to employers sometimes, we feel like employers haven't quite appreciated the extent to which the workers they're trying to hire now are different from the workers they were trying to hire 10 or 12 or 15 years ago. It's still a manufacturer worker, it's still an industrial worker. The wage that I would expect to pay that worker is still X, but the skills that I expect out of that worker are much higher. I expect that worker to be able to operate complex machinery. I expect that worker to be technologically savvy. I expect that worker to have some slightly different skill sets, but they're still a manufacturing worker and they should still be paid sort of these wages. And so I think there's sort of a bit of a disconnect as firms begin to sort of reconcile the reality that my workers require a different set of skills, a higher set of skills, and they have to be compensated for, to Bob's point, for the productivity that those skills engender. I think in the same way in the universities, we're a little slow to be disrupted as well. I think we're trying to partner with employers and really trying to figure out how do we create college grads who are agile workers. Again, building off Bob's point, if the industry in which they operate is going to change significantly in the years ahead, we need college grads who are going to be agile and can adapt to an evolving workspace, evolving levels of technology that complement the labor that they bring to the table. And so we're trying to figure out how do we work with employers, what can universities teach and do well, how can we partner with HR systems inside of employers to create these, again, I keep using the word over and over again, these higher agility workers that can accommodate these changes, because the disruptions are happening, they're happening slowly enough that I think we'll sort of be surprised by them someday, instead of really being proactively trying to accommodate them a little bit. I don't know.
I'll add just one quick thing, and that is when you look at the research, when you take a broad look at the key underlying factors that drive economic growth, there's still a relatively small set. It's things like capital spending, it is things like creating goods that are traded outside the region, and education. And I think it's still clear to say that the number one factor is still education. I think empirically, we still believe that. It's still in the data. Yes.
And innovative ways to consider education and its opportunities and going forward. And it's hitting them at all levels of their lives. Yeah. On December 10th, Oklahoma City residents will have an opportunity to vote on the 4th MAPS initiative. Mark, can you comment on how previous MAPS projects have impacted from an economic development standpoint or really benefited the area?
Yeah, big. That's a big question. I'm gonna
take your time.
I'm gonna condense 8 hours into 2 minutes here if I can.
If you're, then you need to be on sound bites. Okay.
So you're going to miss a lot is the point here. How do you evaluate MAPS? Well, I'm gonna take the economic results of MAPS and look at them. There are several other dimensions you could follow, but it goes sort of like this. Oklahoma City was in dire straits 25 years ago. We're 25 years into this. We spent $1.8 billion, as Percy said earlier. And Oklahoma City, downtown in particular, Bricktown, we're just in dire straits. The hope was really ambitious. Maybe we stop the decline, create a little momentum, build a few attractions, maybe get some hotel activity, and go from there. And as it turned out, every one of the original MAPS projects are foundational pieces of downtown Oklahoma City and Bricktown now. Bricktown is developed way beyond even the ambition of the original MAPS projects. And then we shifted to education immediately after that. And I think the Oklahoma City public school system parallels downtown almost perfectly. They were experiencing the same economic conditions, the same demographic collapse, the same outflow of population from the school district, and the hope was to remedy just an overarching financial problem that the normal ad valorem tax system was not going to cure. We were not going to crawl out from underneath that problem. And I think addressing, essentially deferred spending on the school system and removing that burden to allow the system now, I think you're beginning to see the early stages of remaking the system, at least from a curriculum and an instruction point of view. And then we moved to MAPS 3, some just phenomenal projects. They're almost all finished. You see the Omni Hotel sitting right beside the sales tax funded convention center right across the street from Scissortail Park. These are remarkable projects. And what has happened? Well, what I would argue for you is that nearly everything that was predicted has taken place. Percy mentioned again, $3.9 billion in private sector expenditures, investment. I would argue it's gone well past $4 billion at this point. You have seen not only the investment, but rising property values for the entire area. That wealth creation in the terms of rising property values has been substantial. You've seen, I'll just list a few of these. Remarkable hotel development. You've seen thousands of residential housing units, a complete remake of the residential sector downtown. You have seen the Bricktown area. We track a large group of parcels. You've seen a large group of parcels double in property value since MAPS was first undertaken. You've seen population growth. You've seen employment growth in the region. You've seen rapidly rising wages among the jobs that are downtown. You're seeing all of these things that were hoped for, this creation of a place to live, work, and play. You're seeing all of that gelling. And I would say you can date it really to 2009-ish, 9-10, where there was a dramatic shift in the trajectory of the downtown area. You can see it clearly in the data. Everything accelerated, and what you saw was downtown shifting from a lagging region, lagging the broader Oklahoma City area, lagging the broader Oklahoma County area, to now it is leading in population growth, job growth, wage growth, investment growth. Most of the investment in the region now and for years has been concentrated in the downtown area. A completely remake. I give it 5 stars, 5 tomatoes, whichever is more appropriate. I would add one other thing too. 5 stars for idea, 5 stars for execution. The city employees and staff manage these projects essentially. And you can imagine how this might have gone in other cities that don't function quite as well as Oklahoma City. So I actually think they deserve some recognition for the execution of the plan. All around 5 stars.
Excellent.
Yes. Yeah, one of the things that I really like about the maps, in addition to everything that Mark just mentioned, one of the things that encourages me about Oklahoma City long term is that we're having these regular conversations about connectivity, about public spaces, about innovation. And I think a lot of these conversations we can sort of drive back to the MAPS ideas. I think that, these regular MAPS development proposals and votes encourage in our community these important conversations. And so I think in addition to all the physical outcomes that Mark described, I think one of the things that I observe as a benefit to the process is just the better conversations that we're having around connectivity, innovation, and things like that.
Well, on the talking about connectivity and so on, a lot of American cities like San Jose, Houston, Los Angeles, Albuquerque, and now New Orleans have announced plans to reduce or ban natural gas as a step toward becoming carbon-free in the next few decades. Booming shale production has allowed the U.S. to surpass Saudi Arabia as the world's largest producer of petroleum. And with all of this contradiction, how do we expect our state's energy economy to perform, and what factors should we keep an eye on? Russell.
Yeah, so I'm not overly concerned about companies and cities that are making these big announcements about trying to move away from fossil fuels or embrace renewables. I think when you look across the total U.S. energy consumption, I think the ability renewables can accommodate, support maybe a little less than 20% of total energy consumption. I think that's pretty fixed and growing pretty slowly. So on the one hand, if I was a company, if I was a city, even if I was an energy city like Houston, I would feel some incentive to be a first mover to try to claim a piece of that fairly limited renewables portfolio as part of my own. That's what I'm sort of operating out of and consuming out of. And so when I see companies make these announcements, I don't tend to react too much. To the broader question, though, of how the state's energy economy performs, I'll go back and build off Mark's comments. We've handled this energy cycle incredibly well so far. I think part of that is we don't have 20,000 excess jobs in the industry to cut this time around. And so the job cuts that are coming out are slower, and they're kind of trickling out with smaller announcements. And so we haven't had sort of those big headline announcements that alert us all to the reality of the difficulties that are in the energy sector. And so I do, I mentioned earlier that I think part of the story of 2020 is a decoupling story. If you ask me to place my bet right now as to whether or not I think the Oklahoma economy is successfully decoupled from the energy industry, that we can withstand sort of contraction that we're in right now, I would place my bet that the answer is no, that we have not sufficiently decoupled. And so, again, hence my concern for 2020. Longer term, you look at U.S. oil production at 12.5 million barrels of oil a day. The shale revolution has been just that. So I think there's still a long-term run ahead of us in terms of where the industry and where the United States is positioned to become really a net energy exporter, probably in 2020, much earlier than we had previously anticipated. So I think there's some run there. But I do worry that in Oklahoma, that maybe the level of prices that we need to support robust activity, we kind of tried to convince ourselves maybe it was $45 or $50 oil kept a robust oil field in our SCOOP and some of our other producing basins. Maybe it's not 45, maybe it's 55, maybe it's 60. And so I think as I look down the road, so what factors am I watching? I'm trying to figure out what price is the price that we really need to make our fields work. And the other thing I'm watching is capital markets. Capital markets are telling our companies you got to find a way to constrain your drilling budgets within your free cash flow, and access to capital, to keep your growth paradigms up and running is not there. Capital markets are punishing producers a little bit, and so that's the other thing. As I would look out over the next 2 or 3 years, I'm kind of watching capital markets to see how capital markets respond, to our independent producers and what they're doing here in Oklahoma.
Thank you, Russell. Bob, this is for you. The Federal Reserve has been under close scrutiny recently as it considers future interest rate cuts. With low unemployment and slowing job growth, what do you believe we should expect in the future? Oh, soothsayer.
Well, I don't see a recession on the horizon, and and in fact, I'm willing to guarantee that the horizon's at least 6 to 8 weeks out into the future.
That's a rounding error. Okay.
Yeah, the recession probabilities are up a little, but maybe 25-30% within the next year is something you can find out there, and it's fairly easy to agree with because things are slowing. There are some trouble spots internationally with growth and whatnot, but weakness continuing, but no recession. As far as the Fed goes, well, the Fed is going to be joined at the hip, monetary and fiscal policy moving forward, largely as a consequence of these huge deficits we're running. The fiscal year we just finished, $984 billion, and it was the deficit for the fiscal year that finished in October 31st, and it's scheduled to go to 1.1 in next year. So somebody's got to buy all these bonds, and what better way to buy them than magical electronic entries on the Fed's balance sheets? It's just quite an easy way to deal with the problem of spending well beyond your means. I tell you, folks, we're living in an Alice in Wonderland world here. Government by Twitter. You've got the principal policy goal seems to be let's not let the stock market fall any, because that would be an issue. Quantitative tightening last year, then quantitative easing right away. We had the inverted yield curve, and now it's back to normal. It's just, if anybody really tells you they know what's going on, well, just doubt them. Do you know what's going on, Bob? Well, we're through the looking glass, and so we've got $17 trillion, folks, that's out there in publicly traded instruments, financial instruments internationally that are trading at negative yields. Now, I haven't seen a good explanation of negative yields yet. Maybe there is one out there, but the fact of the matter is, a lot of people are trying to explain them. I haven't heard a good explanation, and there's a lot of concern that they may be coming here. With all these deficits, I mean, we've grown from 60% 10 years ago of the ratio of deficits to GDP to 104%. In 10 years, we've gone to that extent. We're looking at 5% deficits in relation to GDP as far out in the future as you can look. And I just don't know where have all the conservative, fiscally prudent politicians gone? Well, the fact of the matter is politicians figured out how to rig the game, lower taxes, increase spending, reward old people, which I'm increasingly sympathetic with, with Medicare and inflation indexed. So, you know, I don't really know where it's all going, but I do know that I find it hard to imagine our being able to continue down this path without things blowing up eventually. But I know I've been saying this for a long time, and you're tired of hearing it. So
You will be right. Eventually, just keep saying it.
I'm not changing. I will be right.
That's exactly right. That's 100% correct.
Mark, I'm going to have the final question for you before we open it up to the audience. But every 4 years, presidential elections offer us an opportunity to listen to a number of differing economic plans. And likewise, our state seems to always be searching for stability in fiscal policy. Either at the federal or state level, what ideas do you think that are out there that could be especially successful or harmful for growth?
Stability.
Famous stability.
You know, I think there are a number of things that could be harmful, and I think we're already doing a few of them. And I think you have to recognize the fact that the state is really at this point facing an interesting challenge over stability. You know, if you haven't looked at the numbers lately, the natural gas production in the state has doubled in a little over a decade, and crude production has tripled in less than a decade. So we now have, you know, this increased reliance on oil and gas activity. And we do something really interesting in Oklahoma. We take our most volatile tax revenue stream and we immediately apply it to our most permanent expenditure, education. Take it right off the top, and that apparently, you know, you tell me if that's working well or not. But what I think what we're missing is one fundamental thought about the spending side. I think Oklahoma's proven we're pretty good about setting money aside. You know, the rainy day fund has been a really interesting experiment for many decades, and it's actually worked, I would argue, quite well. We have a new stabilization fund we put in place, and we're pretty good about setting aside these reserves. But what we aren't real good at is adjusting our spending patterns to what would be considered, at least in my language, I'm going to call it the core spending or revenue trend. We need to detrend revenue and come up with a number that represents spending as if the oil and gas industry was just another industry. I think that's what we're missing, is the fact that we aren't budgeting and spending on core revenue. Instead, we're just constantly adapting to excess funds flowing out and then trying to bring it back into the budget. And I think you do a couple of things that can help, and I think are really prudent moves. And that is, one, every year we need to come up with an estimate. And this is really quite simple to do. We've been doing it for years, an estimate of what tax revenue would look like if the oil and gas industry was just an average industry. And that number is what we should be using as a foundational basis for spending on an ongoing basis. When revenue comes in above those numbers, put it aside. When it comes in below those numbers, you pull it out of these funds. And I know there's a lot of discussion about endowment funds. I personally am not a fan of endowments being operated by governments. I think you put it there until you need it and you bring it back. If funds get too large, you carve it off the top and spend it. But nonetheless, I think we're missing that one fundamental point about every year calculating that core revenue number. What is our revenue, assuming oil and gas was just a normal industry, and then let's adjust to it. Let's either put excess funds aside or let's pull funds out of savings and use them. And that, I think, is that fundamental shift in mindset that we seem to be missing.
Very profound.
I just say that there, in this political era, there's always talk of new ornaments to hang on the federal Christmas tree, and I just hope that, you know, Medicare for all, well, it's kind of a neat concept, but I just hope that we recognize that a lot of things are about to blow up anyway in the Social Security area. Let's not hang any more on it. I've had a perfect example of this in the household. Be careful what you ask for, because I was finally allowed to have a Ninja blender. And my wife and I were looking at this Ninja blender and the giant canister and the tower of blades that are in it, and she says, "Well, now I will be able to dispose of your body."
One hand at a time. Okay.
So careful what you ask for. There is ultimately no free lunch.
A boiling frog and Ninja cut up. Any other comments on that before we open it up to the audience? Follow that one. Okay. If you will, any questions you have, please raise your hand, and then we'll have someone from the chamber staff come over with the microphone. Javier, you're always up for a question, aren't you?
Always. So we avoided the recession of 2008, and I know the chamber's been working very hard to diversify our economy. Where are we in terms of economic diversity now, and where do you see the biggest risk with that diversity that might impact our city?
I'll take a shot at it. I think we went in reverse the past decade. You know, I described the increase in production. You know, we doubled natural gas production, we tripled oil production. Royalties now are running at about $2.5 billion a year. Production is anywhere from, you know, $15 to $18 billion a year. We have reignited it. You know, I really I don't know if it's even desirable though to diversify away from the oil and gas sector. If you take the past 15 years where the industry has reemerged, if you take the core production, drilling, and support side of the oil and gas sector, and you take refineries and pipelines, that's exactly half of all real GDP growth the past 15 years. So I don't think I don't really suggest that language. I know that's what our instinct is, to diversify away from it. What we've got to focus on is mitigating the volatility effects. And I think we are getting better. The industry's getting better. Government is getting better. Those who are employed or who do business with the oil and gas industry are getting better at it. But I would argue we really don't want to diversify away, and it's going in the opposite direction.
Yeah, I tend to agree. So we just had this talk at the Chamber Leadership Summit, and we talked about, you know, having a specialized economy in and of itself is not necessarily bad. I think Mark talked about mitigating the volatility. The word we used was economic agility, right? How do we create an economy that's agile enough to move from one degree of specialization to another when the time comes? I think part of that economic agility is really trying to find a way to complete a robust entrepreneurial environment. We're just not there yet. We have some of the pieces, but we don't have the full ecosystem that would be necessary to generate the sort of entrepreneurial activity that would create the organic economic diversification. I'll admit that we have not seen diversification happen naturally as fast as I would have thought. So 6-7 years ago, you know, I would have been giving speeches talking about how this technologically intensive oil and gas industry was going to generate innovative entrepreneurial workers that would spin off out of those companies and start non-oil and gas companies using that, that technology and that they were developing inside the industry. And that hasn't happened as quickly as I would have expected. And so I think Mark's dead on. It's not happening as fast as we would have expected, but I don't know that I agree with Mark. I don't think specialization in and of itself is bad. What I tend to think about is how are we positioning ourselves to be agile to move to the next thing when it's time to move to the next thing.
Other questions? Back here.
Yeah, my question is, do you think PMI services and manufacturing numbers have bottomed because they're both pointing towards contraction in the economy?
Did you understand the question? Yeah. Okay.
Yeah, could you repeat?
Do you mind repeating it? Maybe not
Manufacturing
so
index.
close to the mic.
PMI,
Yeah.
manufacturing index, manufacturing activity. Are we in a manufacturing recession? Is that
Correct, yes.
That's the gist of the question.
Yeah.
Thank you.
I think there's a lot of concern there that we, in fact, are in a manufacturing recession. Now you're looking at the chief indicators that we have, the IMS Institute of Supply Management, ISM, indicator is below the 50 mark, and that's generally something that we watch. Employment is suffering a little bit. And so I think that's likely the case.
We definitely are in Oklahoma.
I agree.
Yeah, no doubt.
Yeah, so I'm on my island of concern here, and still feel like particularly Mark talked about Tulsa. Tulsa's a little more prone to changes in oil and gas prices and manufacturing activity. I would still expect that we import more manufacturing weakness than we currently have, and so I am on board with concern for deepening manufacturing recession.
The Dallas-Fort Worth Metroplex continues to grow dramatically, and it's not that far away from us. What's good and what's not good for us about that?
Ooh, you're closest there.
Yeah, you're the closest one. You're almost in the Metroplex. Right?
Well, I got to say that we really need to be studying it more. It's incredible what's gone on in Texas. I talked about earlier how shares of personal income have shifted in the state. Well, since 1990, Texas, in relation to the nation as a whole, has gone from 6-point-something% to over 8% in that period of time. It's remarkable what's happening there. So I haven't really pored over the data to really study how different it is, but it certainly has a lot of growth and very large-scale growth in comparison to the nation. So I would say that they do rely heavily on the property tax down there, and we rely heavily on the income tax, and maybe that might be a difference. The more ways you can find to sock it to the poor, I guess is the greater the growth of your economy will be.
A socket through the what?
To the poor.
Oh, okay, gotcha.
So I think Dallas is sort of a magnet of economic activity. We've talked a lot about the I35 corridor, so I think there's probably some net benefits to Oklahoma City being attached on this corridor. And I was just in a meeting and saw a presentation from a Federal Reserve economist who looks at metro growth. His name is Jordan Rappaport, and he looked at growth rates of big cities and has this article where he argues that as cities grow to a certain size, beyond a certain size, that the cost of growth exceed the benefits of growth. And we see cities that have this exponential, this really fast growth that really begins to curtail as they reach a certain size. And so if you believe that story in Dallas, that maybe Dallas reaches some growth, some size in which further growth really comes at a cost, and maybe that growth does continue to spill up the I-35 corridor, the way we're seeing it. Maybe there's some benefit there for Oklahoma City. I wonder about Dallas, and this is not my area, but Dallas strikes me as more of a collection of cities rather than a city, and so I wonder if they're able to support growth for longer as we think about Dallas and Arlington and Fort Worth and all these cities that seem to be able to just continue. Are they a collection of medium-sized cities that still have a lot of growth ahead of them? Or are they one big city that's sort of reaching the end of its growth cycle? These were just thoughts that came up as I was listening to this presentation. But I think on net, it probably helps us to be on this sort of interstate core of fast developing economic activity.
I'll pile on Dallas a little bit. I remember 30 years ago having a discussion with a real well-known economist in Texas asking about, this very question, what about the linkage between, Oklahoma City, and Dallas? And, there was nothing between here and there. But I have to tell you, I have been quite surprised by the pace of development north. The U.S. is nothing but a collection of big blobs and really long corridors. And I really wasn't sure we would see that Dallas to Oklahoma City corridor develop in my lifetime. And I tell you what, the pace at which it is coming north out of Dallas, have we all been to Thackerville lately? We camped in the campground there a couple of weeks ago, and I have to tell you, it is just astounding. And that's how these corridors develop. We're already seeing those key investments, and I fully expect that at the pace we're going, your question in 20 years is going to be one of the more frequently asked questions about that development of the corridor from, say, Denton to Norman. At what stage are we, and what is happening on that, that loop between Denton and Norman? It is remarkable. It's moving a lot faster than I thought it would. And I suggest that corridor has a really interesting future for the next 20 or 30 years.
It'd be moving faster, but they always have construction on I-35.
Yeah, that's part of it, yes, part of it.
We have 2 minutes remaining. I believe we have a question over here.
Thank you all for sharing this morning. As a fellow economist and also one of the politicians you mentioned, I have a two-parter for you. First, what would be the top 3 policy priorities that you would pursue to help us move in a more positive, stable direction? And what are a few that you've seen us already put in place that have been beneficial towards that growth?
I think Russell needs.
No, I do not want.
They're going to tap dance.
Not make policy recommendations. So I guess I'll just, instead of making a recommendation, I'll just repeat Mark's recommendation. That which is one that we've made before. Which really it's really not that hard to sort of to tease out what a sustainable, normal level of oil and gas activity would be, and figure out what the tax revenue would be off that normal, sustainable, recurring level, and then really taking that excess and setting it aside and being able to really plan around and offset some of that volatility. That really should be something that's doable. That's a proposal that we've thrown out there for years, and I think that would help a little bit on the volatility side. I think, and I don't know what the policy is, but I still go back to Bob's opening comments about the importance of education and thinking about the entire K through 16 spectrum of education. And I think we used this word last year in the same audience. I think we are slow to be disrupted. So we think about disruptive technologies as long as they're not disruptive to me. I don't want to be disrupted. I think we're really going to have to embrace disruptive technologies and think about how do we use disruptive technologies to really rethink our education paradigm, K through 16, and make it something that creates thoughtful, critical workers who can be agile in a changing economy. I don't know what that policy is, but I'd like to see us take a few more chances and be willing to be disrupted a little bit.
And I think the workforce development issues are really, really keen. And to me, how Oklahoma City goes forward in the future is to take this bull by the horns and wrestle it down to figure out what it needs to be, how we coordinate our resource deployment, how we take advantage of what we have in the state, and produce a workforce development system that really takes us into the next 20 to 30 years. And that's and ultimately we'd like our grandchildren to be close, wouldn't we? And so let's figure out how we make this work. And I really think that we have to make it work, not so much from a state level, but from sort of a city-state kind of level. And that's what you've got going for you here in Oklahoma City. You know how to talk internally and how to make decisions and put resources to work. And so I just encourage you to continue those placemaking activities which have been so astounding here and so productive.
Awesome. Mark, Russell, and Ninja Bob, are they amazing economists? Thank you for your great questions. And please recognize our sponsors on the screen. We will enjoy our lunch, and our program will resume shortly. Thank you very much, guys.
Ladies and gentlemen, we invite you to turn your attention to the stage as we resume the program. Please welcome once again the chair for the Greater Oklahoma City Chamber, Percy Kirk.
Okay, I hope you're enjoying your lunch. Please feel free to continue as we resume our program. But before we get going, can I take a moment to recognize the many local and state elected officials who joined us today? Would you please stand? Thank you for being here, and thank you for what you do each and every day to make our community and our state better. I'm now pleased to introduce our keynote speaker. Jason Schenker is the president of Prestige Economics. He's also the chairman of the Futurist Institute. He's a top-ranked economist and financial market forecaster. He's been ranked one of the most accurate financial forecasters and futurists in the world. Bloomberg News ranked Schenker a top forecaster in 43 categories, including #1 in the world for his forecast accuracy in an astonishing 25 categories. He was also ranked one of the top 100 most influential financial advisors in the world by Investopedia in 2018. Before founding Prestige Economics, Schenker worked as a risk specialist at McKinsey & Company, where he provided content direction to trading, risk, and commodity project teams on 6 different continents. Please help me welcome Jason Schenker.
Thank you, Percy. Thank you so much. Thank you, everyone. It is a pleasure to be here in Oklahoma City, and there's one thing that Percy did not mention in my bio, and I did not realize, we would be at the National Cowboy and Western Heritage Museum. I am the only economist I know that only wears cowboy boots. So, yes, and they are Luke Casey's, just like the kind John Wayne wore. So, I also do have an autographed picture of John Wayne in my office, so I wonder how things come together sometimes, and this is a very interesting tale. So there's a couple things I want to share with you before I kind of dive in. People often ask about origin stories, like how do you become an economist, right? There's not, like you ask a little kid, what do you want to be, right? They're not like, when I grow up, I want to be an economist, right? Like, sorry guys, I think we all know that's true, right? So for me, the origin story happened. So in 1999, I graduated college. I had a liberal arts background. I'd studied history and I'd studied German, and I didn't know what I wanted to be. And I had the opportunity to go to grad school for a couple of years and study more German literature, and I thought, that sounds pretty good. And in 1999, it was the best job market in history, and I thought, not being an economist at the time, in 2001, the job market will surely be better than in 1999. And that was the second dumbest thing I ever thought. The dumbest thing I ever thought was that bull ain't gonna turn around. And that was July 12, 1997, Pamplona, Spain. And what, again, kind of the perfect story for this venue. And so as we think about the risks and the economy, and I talk about things, I want to share this story, because most people, when you run with the bulls, right, they think you like run down the road and everybody's in the white outfit with the red scarf and bandana and the whole thing, and that's it. And that's kind of what I thought. But that's not how it ends. When it ends, you end up in an arena, and they have oxen that put the big bulls away, and then they let out baby bulls that are about yay high and weigh, 750 to 1,000 pounds. And people play with them, as it were. And despite the fact, having run down the via, I thought, I'm here for the action, let me just see what's going on. I was also not really a good risk person at the time. So I thought, let's see what this is. So I watched to my left, and there was a baby bull and a guy, And he turned around and started to run from it, and the bull ran over him once, ran over him twice, and then a couple of guys with a stretcher hopped over the 6-foot wall, put the guy on the stretcher, went back over the wall. I'm like, all right, you can't run. I get it. There's another guy, baby bull, still over there running around. Guy puts his hands up in front of his face, and to no one's surprise here, I think, especially at the National Cowboy Museum, this does not make the bull go away. The bull runs over him once, bull runs over him twice, Spanish guys with the stretcher come back, take him over the wall again. So then, I'm standing there, I still have not left the arena, and, because I'm there for the action, and there's about 30 people in front of me and a baby bull, and the baby bull goes left and the baby bull goes right, and there's no more people. And I thought, to Bob's point earlier, I can't get out of the way, you can't run, you can't hide, I'm just gonna grab the bull by the horns. True story. Bull comes at me, I grab the bull by the horns. Now, there's two things people don't tell you about grabbing the bull by the horns. One is, you don't see where you're going and neither does the bull. The second thing they don't tell you is, bulls drool, like a lot. And so I had bull drool all down my leg. Now, eventually I was able to get the bull leaning forward, slide into the dirt. I was covered in crusted bull drool. And that was not great, but I survived. And the big takeaway here is, hopefully after this presentation, you can face the risks and the challenges we might be looking at in the year ahead. And yeah, you might end up covered with a little bull drool, relatively speaking, but we're going to be okay. Now, as an economist, and I know I haven't told you the story about the bull ain't going to turn around yet, but I'll tell you that one in a minute. Because that's a good one too. But there's a cardinal rule among economists. And you can't say, this time is different. Right? There's actually a client I have. They're a relatively large energy investment bank, and they are known for firing analysts that utter the words, this time is different. That's it, pack your bags, you're gone. I've seen it. Out, done. This time is never different. Which is why it's a bit disconcerting that when Jay Powell at Jackson Hole in August said, quote, there are no recent precedents to guide any policy response to the current situation. Like, this time is different? So that's not great. Also, as we think about the outlook overall, we've kind of hinted at some things that are going on. If even the Fed chair is saying, this time is different, maybe we need to take a look at what is different, but maybe not all of it, right? So earlier, alluded to were these. These are called purchasing manager indices. What they are surveys of people who work in companies who buy stuff. Why are they purchasing things? It's because they have orders to fill. When the orders get filled, that turns into a finished good, and the finished goods get counted as GDP. Now, I realize in the US, manufacturing is like 11%, 12% of the overall economy and the labor market. It's pretty small, right? But it's a capital-intense part of the economy, and it leads overall economic growth. There are 3 lines up here. The one that kind of peaks over on the right, that's the US ISM Manufacturing Index. It's fallen. It's been below 50 now for a few months. That's not good. That 50 line in the middle is the break-even. Worse than that is the line that peaked directly adjacent to it. That's kind of a green line if you could see it. That goes all the way down. That's been below 50 for 9 consecutive months. That's the Eurozone. And the red line that's been kind of around 50, and in 5 of the last 11 months it's been below 50, that's the Chinese Caixin Manufacturing PMI. The reason these matter is if you look at the left, you see the Great Recession. You can see all 3 of these dumping off. Then you can see the European sovereign debt crisis, where the Eurozone dipped below that. And then you can see where there's the red line going below it a little bit to the right. That was between December 2014 and June 2016. People don't talk about this. I know we've heard a lot talked about oil and gas. I know how important it is for the economy of Oklahoma and for Oklahoma City, both on an employment basis and for sort of city GDP. Here's the deal. Oil prices fell hard between the end of 2014 and the early part of 2016, not just because of shale. I know that's the story. But during that time window, China, the world's biggest net importer of crude oil, the biggest marginal future buyer of crude oil, was in recession. It's why aluminum, copper, lead, zinc, nickel, tin, rubber, and almost any other industrial metal price you could name fell. They all got crushed. It wasn't just oil prices that fell. We could say shale hit oil, but shale didn't affect a crush in aluminum prices or iron ore or tin. That doesn't make a lot of sense. But maybe a recession in the world's biggest net importer of crude, biggest outright consumer of aluminum, almost majority consumer of copper in the world was in a recession, and that's why those prices took a hit. Over the last year and a half plus, we've seen industrial metals prices fall pretty hard. Why? China's been in and out of a manufacturing recession. Europe's in a manufacturing recession. We're in a manufacturing recession. Now, they don't look as bad as what we saw during the Great Recession, but right now we are seeing contractions in these. So you can also have a manufacturing recession. You can have a business investment recession without having the entire economy go into it. Between the end of 2014 and 2016, actually in 2015 and 2016, there were 2 consecutive quarters of negative GDP components for business investment. Business investment in this country contracted in 2015 and 2016. But in 2015, GDP was 2.6, and in 2016, GDP was 1.6. Those are still positive numbers. The reason is, and this is the big takeaway, 70% of the US economy is consumption. It's people buying stuff. With the lowest unemployment rate in 50 years, it's understandable that if we have a good job market, that means people have money, wages are also up year on year, they can buy more stuff. That's supportive. Also, the Fed is cutting rates and expanding the balance sheet and the whole thing in order to make sure business investment comes back. They were a little bit too aggressive in raising rates, and now they have to push back in the other direction. And we'll talk about that. Am I worried about the Eurozone? Absolutely, but if we go back to that chart, you can see that the Eurozone had a recession back in that 2012 era where there was a European sovereign debt crisis. That didn't spill over to the global economy. So I think there's a couple things to also keep in mind, that even though global manufacturing is in a recession, and this is actually a sum of those 3 numbers, right? They have a break even of 50, so the group's break even would be 150, right? Because there's 3 indices. So for the last 5 months, it's been below 150. So global manufacturing is in recession. Now, this isn't an 80-20 of the world, but it is a 60-40 version of the world, right? Chinese manufacturing, US manufacturing, Eurozone manufacturing, not great, weakest since the European sovereign debt crisis. This is why oil prices have been under pressure. Another Chinese manufacturing recession, biggest net importer, biggest marginal importer, that makes sense. And aluminum, copper, and a number of other industrial metals have also been under major pressure. Again, same reason. Now, if we look across the world, the other thing to consider, these are IMF growth numbers, and the big thing, there's 2 big things I want you to take away from this. And one is that last year, global GDP growth was 3.8, and this year it's likely to be 3. Because of more people on planet Earth every year, you get 3% anyway, which means the global economy is pretty stagnant. The second thing is, last year, the IMF and the Fed were playing a dangerous game. It's called, let's not talk about the trade war. Even in Jay Powell's very first press conference in March of 2018 as the new Fed chair, he was asked, what about the trade war? And he explicitly said, we don't do trade here at the Fed. This is perhaps the most academic thing I've ever heard an economist say. And I know a lot of academic economists. But to try a ceteris paribus argument, right? All things considered, if we exclude the trade thing, we're fine, right? So that's kind of a problem because the trade impact is significant. I'll talk about it in a minute. The second thing here is, I know some of these numbers are small, is that the US GDP growth rates for this year and next year are expected to be the strongest among all of the developed economies. So there's a very complicated and nuanced way that I and some of the economists I know tend to talk about this, and it's that we suck less. And the GDP growth rate, right, for us is still the best of the worst, and honestly, 2 to 2.5% is not a horrible growth rate. It's fine. And it's being driven by that 70% of the economy that's people buying stuff. The other thing I'd point out is if we look at, say, something like equity markets, which are to the left, we're up over 5,000 points since December on the Dow. On the right, you can see stock markets since these are based back to 2007. The blue line way at the top is the S&P. Below that, we've got emerging markets, and below the line, in other words, at lower values than they were in 2007, are the Eurozone and Japan. So the big deal here is the US is really in a much better position than many of the other economies. It doesn't mean there aren't risks and there aren't challenges, but money has to go somewhere, and our markets are still attractive. There's also the fact that our interest rates are still positive, and if you were to buy a bond, you don't have to pay interest for owning that bond. You still receive interest rates for buying bonds. Yes, in this country that's still going on, but in much of the world it is not. Now, against that backdrop, I did mention there are a couple of things that are still worrisome. There are lessons we've learned and lessons we've forgotten. So this is total debt. This is household debt. And you can see we are at record levels, but that's in nominal terms, right? We've seen a decade of inflation. It's no surprise that we might be at new record levels for debt. What you'll see, though, is the areas where debt's increased are not so much in mortgages, which are the orange, but are in student loans, which are red, and auto loans, which are green. Even the number of mortgages is lower now than it was going into the Great Recession. That mortgage line, which is second from the bottom on the right, you can see there are fewer mortgages out there now than going into the Great Recession, even though we've had a decade. Credit cards, that's up, and auto loans, that's up too. This is because the last cycle was fueled by auto credit creation. Every business cycle in the history of the United States, except the one we're in now, was fueled by cuts in interest rates and an expansion in housing credit. That expansion couldn't happen this cycle because of changes in regulation and because of the nature of the financial crisis and the housing bubble and the whole thing. But the credit creation came from somewhere, and that's autos. We look at credit score origination for mortgages. On the left, you can see there's a couple buckets that are quite large, the yellow and the blue. They're down to almost nothing. Those are the subprime groups. The blue, which is credits of 750 and above, that's the lion's share of mortgages out there. Now, auto loans look a little different, right? This is auto loans. You can see the subprime credits on the right. That's where there's been a lot of creation. But here's the thing. I guarantee you, somewhere right now, there are people living in a house they defaulted on during the housing crisis, and they are still living in that house. There's probably quite a few people. But if you default on your auto loan, you're going to pull up to a 7-Eleven and go in to get a Slurpee, and Dog the Bounty Hunter is going to jump in your car and drive away. Your car's gone, right? So, and the auto company gets to keep what you put down, what you've paid, and they still get to resell the car. So that's not a terrible thing to be exposed to. It's really easy to repo. If we look at where the delinquencies are, right, and we look, mortgages are the yellow line, that's the bottom on the right. Mortgage delinquencies, 90 days plus at very low levels. Auto loans, they're up to almost 5%. That's not great. Student loans are also quite high. Those things aren't great. But those aren't things that bring down an entire economy like they did in the Great Recession. Why was the Great Recession so bad? The 70% of the economy driven by people buying stuff was really attacked, right? Because most people had their biggest assets, the biggest things they own in the world, massively devalued rapidly, and that hurts consumer sentiment, that hurts consumer spending. As long as that doesn't happen again, and if we look at the housing credit, this looks like a much more responsible picture, right? We've learned the lessons of the Great Recession, which is good, because we've also forgotten lessons of, say, the 2001 recession. This is the return of earnings per share on publicly traded companies. And what it shows is the return for companies with negative earnings compared to companies with positive earnings. Normally, you'd think companies that are profitable would see a better rate of return. This is for the first day of trading of an IPO. But last year, companies that lost money outperformed companies that were profitable 2-to-1 on their first day of trading. The more you lose, the more you're worth. And that's bad because last year, 81% of companies that went public had negative earnings. It's equal to the record level seen in 2000. So we learned everything from the Great Recession, and we forgot everything from the dot-com bubble. This is a risk. Another risk is something that Jay Powell was talking about back in May. Every year there's an Atlanta Fed conference on financial markets. And Fed chair usually speaks. First time I went, they were invited, there were 40 of us, and it was Ben Bernanke, Dennis Lockhart, and I was one of the 38 sort of other economists. Now it's a couple hundred people. And back in May, Powell was talking about the issuance of risky debt for corporations. And if you look at what's happened with CLOs, collateralized loan obligations, which are not doing well, that's a risk. Same thing, if we look at business leverage, it's historically high. These are risks that the Fed knows is out there. This is the risk to the cycle. That 15% of GDP that's business investment that can be essentially can turn on a dime because a smaller number of people will impact those decisions of business investment, those are at risk. That's a challenge. But look, the Fed can do something about it. They've got this balance sheet. As Bob mentioned, this is sort of a magical thing. This is where it's an accounting trick. It's really quite neat. And I'll talk a little bit later about quantum computing, but let's do a quantum physics thing for a second, right? So maybe you've heard the Schrodinger's cat thing, but this is where the cat's in a box and maybe it's alive and dead at the same time, right? A normal computer operates on binary systems, ones and zeros. I'm sure you've seen that. That's a normal computer. A quantum computer can be both 1 and 0 or both at the same time. The Fed does this nifty trick where they essentially say they have more money. They went from $1 trillion to $4.5 trillion on their balance sheet. They essentially said, we have $3.5 trillion more. And they went out and bought mortgages and treasuries with them. Now, they were reinvesting them up until a little over a year ago, and then they said, we're going to stop. And as those mortgages and treasuries matured, they went back into cash, but the cash never existed, so poof, like magic, the money was gone, because it was never there in the first place. If we look forward, what we see here is the Fed now has had to reverse its balance sheet policy. In between Fed meetings at the early part of October, they said, we're going to re-expand our balance sheet. They're essentially doing more quantitative easing. They're going out and they're buying more stuff with money they don't have that doesn't exist. But from an accounting standpoint, if it matures and then they have the money, but the money doesn't exist, it's fine. So at some point, there's a future quantum state of the economy, right? The quantum computing thing where things are 1 or 0 and both at the same time, where maybe the balance sheet's like $100 trillion and everything in the economy is on it, and the Fed owns everything with nothing at the same time. Could happen because the European Central Bank has been buying corporate debt. And the Bank of Japan is one of the biggest holders of stocks on the Nikkei. Imagine if the Fed went out there and bought corporate debt. Imagine if the Fed went out there and bought stocks. There are precedents for it among other major central banks that are going on right now. And unlike maturing securities like treasuries or mortgage-backed securities, it's going to be a lot tougher to unwind an equity position held by a central bank. So these are some challenges going forward. But if we think about opportunities, I think it's really important to think about trend line over headline, right? So this is the unemployment rate, 3.6%, near the lowest levels in 50 years. We think about what's going on in Oklahoma City, also crazy low. This is a very formal economic way to talk about it. 3%, right? Even at its peak, it was around 6.6% after the Great Recession. National unemployment peaked at 10%. So the unemployment rate here has remained in a much stronger position. I would expect Oklahoma City to continue to see a relatively strong position economically. E-commerce, logistics, transport, these areas are going to see growth as well. So I want to play a little game. I know this is a really smart group. I know you're all really plugged in. I want you to think for a second of a number. And the number is the percent of retail sales that are e-commerce right now. So out of all the retail sales in the economy, what percent of that is e-commerce right now? What do you think? What do you think? Think of a number. Think of a number. And because I know how plugged in y'all are, you know it's 10.7%. Now, other groups I've talked to, not this one, but they often think like 30 or 40%. But it's only 10.7. 20 years from now, it will be 30 or 40%. That's going up. Additionally, another similar trend line is this is the number of employees in department stores. And what you'll notice is from a peak around 2001 until the end of 2017, there were 500,000 jobs lost. But that's not the important part. The important part is the red word at the top, discontinued. This is an economic series that is no longer covered by the Bureau of Labor Statistics, even though 1.3 million people were working in it when they discontinued it. A series not discontinued are employees in warehousing and storage. This added 700,000 jobs over that same period where 500,000 jobs went away in department stores. And by the way, the lowest paying of these jobs pays more than the highest paying retail jobs. So the question of, do robots create jobs? They take jobs, whatever. Look, e-commerce, the self-service revolution is real, right? We all want the stuff. We want it now. We want it cheap. And the only way that happens is by adding technology and more skilled people on the back end who also get paid more. That's going up. Another big important trend line, especially when I talk to folks about oil, is the fact that 30 years from now, there will be 2.1 billion more people on planet Earth. 30 years. And in 20 years, the people in India and China will have real per capita, that's per person GDP, that is between 2 and 3 times higher than it is now. So in 20 years, the real per capita GDP in China will be roughly equivalent to what it is in OECD Americas in the US right now, in 20 years. That's a lot more people with a lot more wealth, and this isn't just like the people that are there now. It includes also all the new people. So you've got a lot more people with more money who are going to want things like cars and durable goods. And you're going to have increased demand for everything, all the trappings of middle-class life. Those are really important trend lines. Now I want to talk for a minute about the political outlook. As with many other things, it's really important to follow the money. I wrote an optimistically titled book a few months ago, came out called The Dumpster Fire Election. Thank you. And following the money is pretty simple, actually. It was a nonpartisan book, and you look, this is the statistics, right? If we look, 2 things. Who votes, right? Folks with mixed political views, about 39% of them consistently vote. If you're conservative consistently, you are double as likely to vote as someone with mixed political views. And if you have consistently liberal views, you're about 50% more likely to vote. As for donating money, if you have mixed political views, about 8% of folks consistently donate. Consistently conservative is more than 3 times that, at 26%. And consistently liberal is 4 times more likely to donate as folks with mixed political views. So why would you ever pitch to the middle? It's not where the money comes from. It's not where the votes come from. This is what will drive everything in the next year. Additionally, if we look at where the money is then spent, in 2016, 99% of the money was spent in battleground states. And the top 4 are Florida, North Carolina, Ohio, and Pennsylvania. That's where almost 30% of the money got spent. So there's a couple states, obviously, that matter the most. But the big thing, too, that you should think of is for Florida, the last Republican to win Florida to win without winning Florida was Calvin Coolidge in 1924. The last Democrat to win without winning Ohio was JFK. And the last Republican to win without winning Ohio was no one ever. So think about that in terms of priorities and why the money is spent there and how the pitch is going to be, and then be, kind of grateful you don't live in a battleground state. I gave a talk a couple weeks ago in one of these so-called purple states, and I told them, I haven't owned a TV since 1993. If you still have one, you may want to get rid of it now. But for the outcome, there are 3 potential outcomes. I know we heard a few things earlier about the debt. The national debt's gone up a lot. There are 3 potential outcomes. The Democrats win everything, and the debt goes up. The Democrats and the Republicans split things, and the debt goes up. And we saw that last fall. There was a pretty big bipartisan deal around the budget. Why? Because it was so big. And there's a third outcome, which is Republicans win everything, and you guessed it, the debt goes up. It's choose your own adventure that ends in all debt going up. And maybe you're skeptical about this, right? You think, Jason, what are you talking about? So I happen to be one of the 100 CEOs who sits on the Texas Business Leadership Council. It's like the business roundtable for the state of Texas. We advise state and federally elected leadership. And last year, we made a trip up to D.C. and met with most of our delegation, so both of our senators, most of our congressmen. And the topic was NAFTA, right? In Texas, it's 1 million jobs on the hook around it, and that's why we were there. We were there explicitly to talk about NAFTA. But we happened to be at the Capitol Hill Club, which is the Republican club in D.C., for lunch. And we had a Republican congressman hosting us with 10 Texas CEOs around the table. And we said, look, we're here about NAFTA, but we're also curious. It's the 3rd week of March. And we say, there's a budget coming through. Is the budget going to pass? Republican congressman at the Republican club with 10 Texas CEOs says, oh yeah, we just got to pork the bill up a little bit. This was in early 2018 when the Republicans controlled the House, the Senate, and the presidency. Here's the deal, gang. That debt is going up no matter what happens. Now, there's also a movie that's been made about how the bad debt stuff could end. And you might be thinking maybe it's like The Big Short, right? The movie you might have seen that's about the mortgage crisis and this sort of thing. But in our current environment, where we see interest rates going lower and the central bank buying treasuries and mortgage-backed securities and pushing interest rates down, and we live in a negative interest rate environment, I want you to imagine for a moment where we have all that debt and negative interest rates, where we actually get paid more because we have an obscene amount of national debt. The movie about this, which is also a play, is The Producers, right? Where the more you lose, the more you make. It's also not too dissimilar from what's been going on in the IPO world recently. So yeah, The Producers, the economy edition, could be coming sometime soon with negative interest rates. Right now, in the last couple months, you've seen banks in Europe that are issuing mortgages with negative rates, right? You get your statement, and there's a principal you owe, and then there's interest, and it's a negative line item. You get paid to have a mortgage. I'll take a jumbo. I'll take two. But the flip side of that is, if you put your money in the bank, you actually have to pay interest to the bank for your savings account. Try that one on. This is how weird it could get. But because we have all that debt, government might soon have a line item, interest, negative interest from the debt goes into the budget. Imagine that. Now, on the trade side, there's a couple things to keep in mind. And the first is that the trade situation with China is not fundamentally about tariffs and trade. It's about other stuff. The U.S. trade czar Pino Navarro has written 3 books, all with subtle titles, about the U.S.-China relationship. These have been out there. You can buy them on Amazon. They're like $10, $15 each. They've been out there for more than a decade. The first is The Coming China Wars, Where They'll Be and How to Win Them. Then there's Crouching Tiger, What China's Militarism Means for the World. And my personal favorite, Death by China. Very subtly titled, and they should imply that this might not just be about trade. The most important thing, of course, is these are written by the U.S. trade czar. Throughout the last 18 plus months, people have been very optimistic every time, there's going to be a trade deal. We're going to have a trade deal with China. We're going to have a trade deal. We are not going to have a major trade deal with China. This is a national security issue. There are things at risk. If you look at the tariffs, there was a conflation in the broad-based media, and we're not talking about any kind of partisan thing. I'm talking about wire services, AP, Reuters, Wall Street Journal kind of stuff, where when the Section 301s were implemented, people were still talking about the 232s. And these must just sound like I'm talking about numbers. So let's take a second. The Section 232 tariffs are the ones that apply to aluminum and steel and are designed to make sure that in the United States, we can still manufacture weapons. The Section 301 tariffs explicitly targets Chinese intellectual property theft of high-tech weaponry and other high-tech stuff, right? So if you saw the parade of all those newfangled kind of high-tech weapons the Chinese showed at their anniversary at the beginning of October, the People's Republic of China, yes, so not all that tech was developed in China, right? And this is why the 301s might not go away, because it's about national security. An example of this are quantum computing patents. I know I've talked about it already. There's 2 lines of the chart. The one that's up at the top are the Chinese patents around quantum, and the one that's lower are US patents around quantum. And by the way, the trade war thing is working. If we look at winners and losers, the big loser on the left is China, that's in red. The big winner on the right is Mexico, and the little yellow bar in the middle that's a little bit up is the United States. So if it's working, why would we stop? Well, the argument is there's a projected GDP loss, and it's hurting the global economy. The new head of the IMF said there's a risk of a digital Berlin Wall going up, right? This could be a digital Cold War that we're seeing. I have news for you, it's already been going on. And China's now, although people will hear about various partisan things in the next year ahead, a bipartisan issue. There have been people on both sides of the aisle who supported initiatives. Last fall, when there was a debate about the budget and Republicans and Democrats were at loggerheads, they were able to get a $1.2 billion bill for quantum computing pushed through with bipartisan support. Even though the budget couldn't get done, that got done. On the very first debates for the Democrats, on the second night, there were 10 people on the dais, and they said, what's the biggest national security risk? And 4 people said climate change, 1 person said Iran, 1 said Russia, 4 said China. This is clearly a national security thing. And even though there may be a global economic impact, there are bigger risks at play. We did a large project a few months ago for one of the biggest tech companies in the world. And we spent about 3.5 months on it. And at the end, we had 3 words. And I realized spending 3.5 months on something and coming in with 3 words might sound like, what, that's it? We pay for 3 words? But let me share the 3 words. And then we'll see what you think. The first, we said, was the trade war is about hegemony. It's about China exerting control on a 20, 30-year time horizon over much of Asia and much of Africa. They've been investing money in Africa to secure supply chains of all kinds of raw materials. The Belt and Road Initiative is out there. China's been building up islands, man-made islands, into bases in the South China Sea. They are planning to try to control more. And by the way, if you doubt this, we could have a discussion about the tweet of, right, the general manager of the Houston Rockets, an American who tweeted to, support Hong Kong, support democracy, right? This is an American for the American National Basketball Association, whose logo is red, white, and blue, who comes out and tweets in favor of this, and the next thing you know, all the Rockets stuff is pulled off Alibaba, their television contract is busted, they're out. And then you have all kinds of new Chinese political pundits coming out, like LeBron James, to state what they, how wrong he is about China. Simultaneously, you had Ted Cruz, Beto O'Rourke, and Julian Castro coming out and tweeting that it was really shameful that the NBA was trying to kowtow to China. Now, other than the fact that Texas barbecue is superior nationally, I don't think that Beto and Julian Castro and Ted Cruz would agree on much else. Second thing, we said this, so this is the big risk. Triage is what's going on right now. Every single tech company out there is trying to get some of their manufacturing out of China. And they're trying to move it to Taiwan. And we told our client, as we've told our other clients, Taiwan is not far enough away if you don't want to have to move your supply chain in another 5 or 10 years. You need to go further away than that. Look at what happens with Hong Kong. We're not doing anything, we're not saying anything. Tiananmen Square, didn't do anything, didn't say anything. When's the last time you saw a Free Tibet bumper sticker? We are not going to do anything for Taiwan. It is not far enough away. A lot of companies think it's just about trying to avoid the tariffs, but in the high technology sector, you've got to get as far away from that reach of Chinese hegemony as possible. Which led us to the third word, which were proxies. Most of the wars of the last 120 years have been proxy wars. Look at what's going on in the Middle East. Look at what happened during the Cold War. Even we could argue, look at what happened before the Second World War, right? The Spanish Civil War didn't drag parties into a global conflict, but it was a proxy war between the Nazis and the communists. World War I, it did. Serbia did drag everyone into it. But for most of the last 120 years, it's been proxy wars. And if you're China and you want to exert economic hegemony over much of Asia, you want to make sure that those countries that could kind of stand in your way, you can try to mess them up a little bit. So a country like India that's economically, politically, religiously, ethnically divided in many different ways is like Yugoslavia times 20, and it probably wouldn't take much to create a proxy war there or mess it up. And there's other economies, like those in Latin America, that are vulnerable and exposed, right? Venezuela has a problem. China's there with some cash. Brazil is having some issues in its own current political structure and what its future looks like. China will be there with some cash. So what countries not only will be outside the immediate reach of China in Asia or Africa, but also what countries will try to mess up if they can't control it. This is what's coming over the next 30 years. This is why we're not going to have a major trade deal. Could we see a little something that looks like the trappings of a deal? Sure. But how are we going to enforce the rules and regulations to prevent stealing of critical technology and IP from China? related to robotics or AI or quantum computing, the more advanced the technologies get, the riskier it is when they steal it. Also in technology, and I know I've talked about quantum computers, and this is the one Google just a couple weeks ago did a calculation in 200 seconds that would take a classical computer, the most powerful supercomputer that operates with those ones and zeros, it would take that computer 10,000 years. And this quantum computer did it in 200 seconds. But that's not the technology I want to talk about. I want to talk about this chair. So this is a chair. This is in Frisco, Texas. And in the background, you can see another building. It's actually the practice area for the Dallas Cowboys. And the chair, which we'll come back to in a second, it's really interesting because you see all the Cowboy stuff, and you go back across the street and you see the chair. And this is interesting because the chair is in a place called Complexity. Complexity is the new esports team that's affiliated with the Dallas Cowboys. They have a lounge hosted by Miller Lite, where many of the players are not old enough to drink. This is the training room. This is one of their training rooms where the team goes in, they get hyped, they sit down. This is where they practice. This is where they review the plays. This is one of the coaches showing us how they review the video game plays on a play-by-play basis with the esports team members. So that way next time they get it better. And this is where they've designed certain techniques to help improve response time by milliseconds for those esports gamers. The chair is where everyone goes after they've had a match and it's been very stressful and they need to decompress. They go sit in the chair. And behind the chair is the building, the first one, where the Cowboys have their training facility and their workout room and their nutritionists and their doctors. And because this team is affiliated, it's also where the gamers work out, get fed, see doctors. So I'm imagining a linebacker going in, and you've got like gamers trying to bench press, and they got to work in a set around those gamers. This is a real thing. I'm not making this up. I wish I was. It's crazy. And I know you might be thinking, this is just a game. These are just games. But so are all sports at one point. The reason I mention this is because it brings back to what I talked about earlier with the trend line over headline, and that new jobs are often created in ways we can't even imagine. As we're trying to think forward about things, imagine this as a multi-trillion-dollar industry. People filling stadiums to watch people play video games. It's going on now, and it's going to spread and get even bigger. A couple key takeaways from some of the highlights I've talked about today. Now, the first is, if we think about upside risks, right, the U.S. economy has been expanding, right? Things have slowed in terms of the ISM, which is contracted, or consumer confidence, but 70% of the economy is driven by consumption, and the job market's strong. The Fed's cut rates. They can do more and very likely will. Quantitative easing will likely continue, right? And the U.S. is in a relatively solid position compared to other economies. We still have positive interest rates. Our equity markets have outperformed. The money has to go somewhere, and it's coming here. Trends for e-commerce are rising, and we're going to see new industries form around new kinds of tech. Additionally, as the trade war continues, we're going to see more manufacturing in the U.S. And what you're probably going to see is higher value add, more automated kinds of manufacturing. So the jobs that are created around it are higher tech, higher skilled jobs. In the 1970s, the most common job by state was secretary. Today, most people don't generally even use the word secretary. And right now, the most common job by number of states is truck driver. And I wager 40 years from now, we won't use the words truck driver either. Maybe something like automated fleet vehicle engineer or something like this. But we see job markets continue to change over time. On the downside, we've talked about the lowered growth rates. We've talked about trade and tariff risks. that there is a US business investment recession, Eurozone manufacturing, Chinese manufacturing recessions, and there's also the fact that labor costs have been rising and the market's relatively tight. There's a couple other areas that we're worried about. Auto sales, housing, those have been a little weak, but lower interest rates, those should boost those. They should also boost business investment. We think by the second half of the year, things will look a lot better. We've been consistently forecasting GDP this year would be between 2 and 2.5%, and next year between 1 and 1.5%. That's likely to be pretty good. And while some occupations are at risk of automation, we do see those other opportunities. The last thing is that there is a risk of a technologically bifurcated world going forward, and that China's playing to win. Now, the last thing I'll share is that although many things are changing, some remain the same. And so as an economist with a table of economists up front, I want you to realize that there are always two factors that will drive markets. You know what they are? What are they? Supply and demand. I thought you guys knew that this was fear and greed. Come on, guys. Well, thank you very much. Thank you. Sure. Let's open up for Q&A. Go for it.
Do you have any questions? We'll bring the mics out to you. There's one right up here.
What would happen if we paid for Medicaid for all? And secondly, you talked about Texas barbecue being better than Oklahoman. Is that how you started it because you mentioned an economist and a bull?
Okay.
You can answer that second question first.
So, and I said that the exact quote about the barbecue is that these three Texas politicians would agree that Texas barbecue is superior. I have not sampled Oklahoma barbecue, so I cannot speak to this. So allow me to first say that. My wife's family is from Oklahoma, so, good things to say. So, and the first question, which I have now completely forgotten because of the importance of the debate about brisket. Medicaid or Medicare for all. So here's the deal. We worry about the national debt, and the national debt's $22, $23 trillion. Entitlements, which are Medicare, Medicaid, Social Security, are a $200 trillion off-balance sheet obligation. So almost 10 times the size of the national debt, and over the next decade, they threaten to be a really big problem. The challenge of doing something like Medicare for all, and this is a point that a couple people on the panel made earlier today, is we already have a $200 trillion off-balance sheet thing. If we make it bigger, then that becomes a problem more quickly. Entitlements are designed to be self-funded, Medicare, Medicaid, Social Security, right? But they've been pulling on the operating budget since, I want to say 2003 or 2004. In other words, the budget has already seen negative draws to pay for that which should be self-funded. So let me ask you, I'm curious. If you go on the Social Security website, there is a picture of the grandfather of Social Security. Does anyone know who this is? It's on the U.S. Social Security website. Anybody know who the picture might be, the grandfather of Social Security? Roosevelt, FDR, stuff like this, right? Otto von Bismarck. And the reason he's up there is because in the 1880s, in a new Germany that had recently been formed, there was a rising socialist party, and to take the winds out of the sail, Otto von Bismarck, the blood and iron chancellor, not the bunny rabbits and rainbows chancellor, as you may have otherwise thought, but Otto von Bismarck, the blood and iron chancellor, implemented a top-down form of Social Security. And in the 1880s in Germany, the benefits age was set at 70. Again, blood and iron. Anyone want to guess the average age of life expectancy in 1880s Germany? 60, 55, 40. So there was a 30-year spread between when you were expected to die, and if you lived 30 years longer, you got Social Security. Blood and iron, baby, right? And that math works But what you'll notice is Social Security in the US pays below 70, and the life expectancy is way above that. The demographic trends are what already puts a burden on the current system, which is based on a system first implemented by a Prussian monarchist. So this is a really nasty thing that's quite challenging as we think about the budgetary implications. How do you unwind this? People expect this. If you look at the percent of people who expect Social Security to be not just a majority, but I want to say something like a third of Social Security recipients have that as 90% of their income. What happens if we become even more reliant on entitlements that are not funded? What does that do to the budget? What does that do to our long-term economic growth? It's not great. And out of all the taxes that were reformed in the recent tax reform, there was one tax no one talked about: payroll taxes. And that's because they're going up. And if we were to have a discussion about what economists and futurists tend to call the robocalypse, where the robots take all the jobs, we could talk about a time where companies are incentivized to remove all the people from their workforce because they have to pay payroll taxes. So let's just have lots and lots of robots we don't pay payroll taxes. This is a challenge. Please.
So I'll tack on to the robocalypse. Are there industries or geographies that might be surprising, that might be impacted by that? And is there a scenario, there's some talk about a time when a lot of people don't have work. There's not work that needs to be done, and so people have all this idle time? Or do you think there will be jobs that fill in so that everybody who wants to work can work?
Okay, great. So 2 questions. The first is, how do we fight back against the robocalypse? What is the weapon we can use? We heard it alluded to earlier. It is education. Making sure people have degrees and certificates and they are prepared for a life of perpetual learning. This is really important, right? In my grandparents' generation, if you graduated high school, that was enough. And in my parents' generation, if you graduated from college, it was enough. And in my generation, it's if you have a master's degree, it's maybe enough for a little bit. But for folks now who are millennials and later, you need to be prepared for perpetual learning, constantly adapting because technology is changing. But although technology will change at an increased pace, I think people will always have things to do. And they will need things to do, right? This is the whole lesson of Greek mythology, right? You have a bunch of these deities sitting around, they've got nothing to do, and they destroy the world. Right? Anybody owned a German Shepherd and left them alone with nothing to do for the day, right? And you find they destroy all the furniture in the house. This is what people need something to do. And 10 years ago, if I asked someone graduating from college, what do they want to do when they go out into the world? They would not have said, I want to be a Facebook marketer. I want to do content creation. I'm interested in social media marketing. It didn't even exist as an industry, right? And there's going to be entire new industries 10 years and 20 years from now. Partially because people will need something to do, and partially because the new technology gives rise to new things. And I would offer one last thought to put this kind of in historical context. Anybody know what the most common last name in the English language is? Smith, right? Unless you've been to a Renaissance fair lately, you haven't seen a blacksmith at work, probably. And yet, 1% of the people in the English-speaking world have the last name of Smith. It was an occupation for 1,000 years, and then it wasn't. And jobs change, right? But in the 1850s, if you had been a blacksmith, you might have needed a new job, right? Because factories replaced you. I guess you could have talked to millers, weavers, tanners, and seen if they were hiring, which they weren't because their jobs were being disrupted. And so you kind of went to a city where you knew no one and had never talked to anyone on the phones. The phones didn't exist. There was no way to know what was going to happen, and you just kind of went somewhere. Retraining, forget it. Today, you can go online and take courses instantly. You can look for a new job instantly. I think you're going to see an even more rapid adaptation and fluidity and efficiency in the labor force going forward. So imagine a day 20, 30 years, imagine a day 10 years from now where you're thinking about quitting your job and you already have 3 backbench offers where you've been matched to your next job. You just go, you know what, I'm out. And boom, you get matched to your next one and you're out the door to your next job. Other changes that will happen is remote work. So in the last decade, people who telecommute increased by over 100%. Today, 50% of jobs offer people the opportunity to work 1 day a week from home. 70% of new job listings offer that opportunity. In 20 or 30 years from now, we might see 50% or more of the workforce working from home. These are going to be big changes, but it will lead to potentially more rapid changes in the labor market, but more efficiency in them as well. So we're going to see different things happen, but I don't think we end up with a full-blown robocalypse, and I don't think we end up in a world where no one has anything to do. There are a lot of jobs that won't be able to be easily replaced. Medical is one of them. We think about the demographics and the Medicare and the Medicaid and the aging population, the graying of America, the whole thing. You're going to need, you look at the BLS website, which is the Bureau of Labor Statistics. They have the job numbers. Of the top 10 categories, the majority of them are all around health care. That's really tough to replace with robots. Another one is trades, right? Electrician, plumber. I will take the other side of this bet with anyone that before we have robots that can go into a house and fix the plumbing in any house, we will be tearing down houses and reprinting them when there's a big enough plumbing problem. Right? You just think, oh, that's it. We got to call the moving company again. And you get all this stuff out of the house, and they just tear it down and reprint it. Because it's too complicated. Each wall is different, each plumbing, each electric, it's all different. Very difficult. Those won't be replaced. And if you think school nurses will be robots anytime soon, I have news for you, right? Anything that involves people, relationship stuff, that's not going to happen. And project management, planning, anything like that, those are going to be people too. And I would offer the example around that of, I'm sure many of you are executives or might sit on boards, or maybe you sit around rooms of people and you're trying to make big, important corporate decisions. And the decisions are always around, what's our priority? Are we on track? Is stuff getting done? Some of you may be on teams where you essentially have an unlimited budget and can hire as many people as you want. And yet, we still struggle with, what's our priority? Are we on task? Are things getting done? All the AI and robots in the world is just more leverage that needs to be managed. It's stuff that can help you get the things done, but the process still needs to be marshaled. People need to make decisions about priorities, the whole thing. So those things are going to be really important for a long time to come.
Please join me in again thanking Jason Schenker.
Thank you very much.
Thank you, great questions, and thanks again, Jason, for joining us. I know that today gave us a lot to consider as we plan for what the future holds, but no matter what's ahead of us, one thing remains true. It takes us all to create a strong business climate. In Oklahoma City, we know that when we continue to invest in ourselves, we'll see a positive return on that investment. Residents of Oklahoma City will have the opportunity to continue those investments on December 10th when the proposed MAPS 4 projects will appear on the ballot. I don't need to tell this group how important it is that the MAPS programs and projects have a favorable outcome on this December vote. What I do want you to remember is that it's up to us to continue this momentum. The deadline that you may not know about, but really important to register to vote, is this week. So please confirm your registration. Make sure you're prepared to vote yes on December 10th. And one more time, if you want to learn more about the campaign and Oklahoma City growth for the next generation, visit loveyourokc.com. Once again, thanks to our signature sponsor, Arvest. Thank you. And all of our sponsors who made this event possible, and we are adjourned. Thank you for joining us.